Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me typically would be the man himself, great state of Texas of real estate, Mr. Michael Becker, but he is on another due diligence assignment. In fact, he's out in California these days trying to pick up a bucket of money. So good for him and his folks over at SPI. In the podcast today, we have a couple of our loan officers because the theme of this podcast is really the 2024 first quarter loan officer roundtable. And we're going to talk a little bit about what's working and what's not working in the capital markets. As you know, Old Capital is a nationwide lender and has closed billions and billions in commercial real estate loans. Most of the transactions are multifamily. Most are in Texas, but we do loans throughout the entire country. Today, as we said, we have James, the Professor Eng, in the house. We have Ricardo Hinojosa. We have Julie Peterson, and we're going to talk a little bit about what we're seeing in the capital markets. So people don't know what capital markets, what that term really means. It's the lender, it's the loans. And that's something that you want to know is what is being approved today, what type of loans are getting closed, whether it's a Fannie Mae or Freddie Mac, FHA loan, a bank loan, other different types of transactions out there, how they're being structured, what initial rates are, and really what can we expect in today's lending environment? So you'll hear some of the good and the bad. You'll hear specific stories on what is working, what is not. As you know, we at Old Capital don't want to see anyone lose any money in their investment. So please pay close attention today. So if you're a passive investor or a general partner, I think everybody will learn something. So James and Ricardo, you're kind of the senior folks. It's the middle of March of 2024. What's the temperature like in the commercial real estate market? Let's just take a real overview about what you're saying.
Ricardo, you want to go first?
Sure. So I think the first couple months of the year, we've sized a ton of deals like we always do. So in the markets that we're in, we're sizing pretty much every multifamily B and C asset that is trying to be sold, that hits the market, that's off market. We pretty much size them all. There are plenty of buyers looking for deals, but they're looking for the deal. They feel like, hey, given what's happened in the capital markets, we're waiting for deals. So the transaction volume is a little down, obviously, but the deals that are making sense are the ones that where there's some motivation on the seller side. And does the deal qualify for Fannie or Freddie? And does it underwrite for Fannie or Freddie? No longer are we kind of, hey, okay, it's 50% leverage, let's go to a bridge loan. Most buyers are, if it's not 65, 70%, right down the middle with agency, at least my buying pool is they're really looking for B and C class deals that underwrite well going in. We can get to about 70% leverage, and those are the deals that are happening. Now that they're far and few between. Most deals aren't underwriting, but those are the transactions that I'm seeing. Cash flowing day one type of deals.
James?
Yeah, I mean, I think it's, I didn't read that much in high school, but The Tale of Two Cities to some extent. I think that was one of the longer books out there that probably got the Cliff Notes version. But, if you pick up, the Real Deal or any of these, all you're seeing is the headlines of crisis out there. And there are deals getting foreclosed on. There's deals getting worked out right now. And that's bringing about sort of deals underneath the table to some extent. They're not coming to market. They're getting traded out between one general partnership group with another general partnership group. And the basis is essentially the loan amount. So the new guy coming in is buying the deal at the loan amount, but they're having to bring all the CapEx dollars to take it from 60% occupied to 100% occupied or 90% occupied. And they're having to feed the deal for the first 12 to 18 months with an interest reserve. And so we're seeing some of these deals where the GP is getting switched out, and those basis on those deals might be 70, 80 a door on a Class C deal in Dallas. And you're seeing that, but then you're also seeing deals that are 95% occupied and they qualify Fannie Freddie, or they're set on a loan assumption. And those deals are trading at 130, 140 a door on a Class B deal. So I think it's a little bit a tale of two cities. There's deals that there's really no distress. There's no distress on the property. There's no distress on the loan, where there's other ones where it's distress on both. And so I think you have to figure out as a buyer, where am I going to play? Because are my investors willing to go in on a deal that is 60% occupied today and needs 10,000 a door in rehab? Or do they want a coupon clipper that is a HUD loan assumption or a Fannie assumption, and it's a fixed rate at 3.5% to 4%, because that seems to be what's selling right now. And I don't have to do a ton of rehab. And so I think you got to take a little bit of a temperature with your investors to figure out what type of deal are they willing to go in at. And then based on that, go after those types of deals, because those are the two deals that are trading right now.
Julie, what are you seeing out in your world?
Well, I see a lot of the smaller deals getting some traction. I work with a lot of new investors, and I think one of the challenges that we're facing in the new investor pool is the equity is really, really difficult for them to find and to bring in. There are a lot of these education programs, I think, make it sound very easy. And, in past years, I think we've had some great success, but this new group of students, if you will, are really struggling with the equity. So we're trying to really ask the questions like, where's the money coming from? Do you have that all set up before? We need to have some realistic expectations on how long that's going to take. And are you going to be able to find that in the next 60, 90 days? The other thing that I have come up on some of these deals that we're looking at is the deferred maintenance on these deals. The last 3 years, a lot of the investors have really set their sights on trying to return capital to the investors, but they really haven't looked at, how are we going to fix this in terms of the stuff that doesn't help rent, doesn't create a rental increase. So your landscape maybe needs a little bit, your parking lots probably need some attention, maybe some paint maybe that they haven't gotten to. So I think we've seen just recently that when the PCAs come back, which is your property condition assessment comes back, that, each person, the seller is saying, I'm not paying that. And the buyer is saying, well, I'm not paying that. So there has to be a middle ground. There has to be some people or some conversations, I should say. And who's going to take care of these? If you know them up front, that's going to have to be part of the negotiations. But the stuff behind the scenes that comes in after you're under contract, how much does that seller want to sell it for?
Yeah, and I mean, I think that comes into play on new loans, like Julie's talking about, but then especially on assumptions, because the assumption is you've got one lender. So you've got one guy who can give you that 4% rate for the next 8 years or 7 years with all that IO at 4%. And so when they go out there with the PCA guy, that's going to be a little bit more detailed of a PCA. So your engineering, your immediate repair holdback might be a little bit higher than your typical deal. And then they're going to come up with an interest reserve if that deal's in any distress as well.
Just some of my notes that I want to kind of share with you, maybe on a Class B or C property. And just like Ricardo was saying, is that there's a big delta between a buyer and a seller these days. And there's not a lot of inventory out there. Not a lot of properties for sale in the market today. So anything in the market is seeing high tours and offer counts. So sometimes you'll see maybe 250 people that will download the trailing 12 offering memorandum, the rent roll, and then try to figure out what they have on that. And then you may have 40 or 50 tours on a property. Maybe you get 20 offers. So the selling agent kind of gets a good pulse about what the market is willing to pay through the process of the sale. From many conversations that we're hearing from the equity providers this year, as well as other properties of in the B and C market, I think that the following is abundantly clear that what equity wants right now, and James, you have to tell me if this is right. There's more money in the core or the core plus assets, also probably known as the pretty little new construction deals, either downtown or in the suburbs, and that there's some money available for the 1980s vintage with the 8-foot ceilings. That's the value add story. But I won't say it's kind of a no bid, but there's limited capacity or limited capital for the 1960s and 70s vintage deals. So if the property is in the hood, as Michael Becker says, or has a bad physical characteristics like a chiller or aluminum wiring, the cap rates buyers are required to pay these days are so high that sellers won't or can't meet the market. I think what we're seeing is the meat on the bell curve these days is the 2000s or newer, the suburban class A deals or A- deals with maybe 9-foot ceilings with a value added component. And I think that is kind of more the holy grail right now of getting both the institutional capital and the private syndicators, equity groups, they're chasing it. So I also think that we're going to probably see a lot more inventory coming later this year. We were just talking just a while ago about taxes and insurance. So before we started going to lending, Ricardo, what's your 2 cents on taxes and insurance? We do a lot of business in Texas. I've heard insurance premiums are coming down. Is that true or not?
I haven't seen insurance premiums come down. Like I said, we pretty much underwrite every deal, and I say on average we're seeing about $1,000 a door on insurance, right? No more 500, 600, 700 a door. Those days are gone. For the most part, it's up there, on a B and C class asset, and that 1,000 a door is kind of where everything's shaken out, at least the deals that I'm seeing. On taxes, the implication right now is taxes are about to come out, right? The new assessments are going to hit next month, and we're scrambling, right? So if you were going to refinance and you're at a certain NOI today, as soon as those taxes come out, your NOI has just been reduced, more than likely, right? Until you protest them down. So there's, we've been harping on this for pretty close to a year, right? Anyone that needed to get out, and if you were, right there on your refinance, now is the time to be going. And so we're kind of right there on a lot of deals right now. So we're just scrambling to get those done before these assessments hit. But that's been the game plan on these deals for a while. So
let's turn to lending, which is our forte. And what's being approved today, on a purchase transaction these days? What is a percentage, whether it's Fannie Mae or Freddie Mac or bridge loans or bank business? How would you kind of describe transactions that are being approved and closed and funded today? And what's the percentage of the agencies versus the bank business?
Well, we're primarily doing pretty much all agency. We'll do a bank deal here and there on the small stuff. But like I said earlier, the transactions are those that qualify for agency going in. So high percentage, 95% on my end. And I would imagine, for the group, it's up there too. Straight down the middle, Fannie and Freddie. In terms of Julie was talking earlier about how it's tough on the equity side and equity scrutinizing deals a little more. Fannie and Freddie are scrutinizing the deals a little more as well, whether it's an acquisition or a refinance. The latest piece on that I've seen come up in the last, I would say 60 days, is on Freddie Mac's side, making sure that we've got enough skin in the game from the GPs. And
so that's changed. So what can you go in a little bit more detail about what that means?
Historically, so usually we'll have, 2, 3, let's say a couple, 2 or 3 GPs signing as guarantors. Well, in the past, as long as, the combination of the 3 guarantors were, let's say 5% of the equity, we were normally a thumbs up, right? There was not a lot of scrutiny behind how much skin in the game the GPs had, as long as it was, let's say, at least 5% total. Well, what we're seeing right now is, especially on kind of the medium tier deals, let's say 5 to 10 million, the Freddie SBL side of the table, is that they want 5% from the most experienced GP. So normally, well, in a lot of these transactions, we'll have one GP that's a strength and maybe another 1 or 2 that have done 1, maybe 2 deals, right? So not as strong, but you got one individual that's that really is the strength of the deal. They're wanting 5% out of that individual, right? So that's been a change, and that's been a
Was that individual typically that brought the experience didn't want to put any of his own money in the deal?
yeah. Historically, you put something in, but maybe it was 1%, 0.5% of the deal, and then they're taking right their share of the deal, which everybody's happy, right? He helps them qualify for the loan, he or she helps them qualify for the loan, and then in exchange, that individual gets a share of the GP. Well, that's not good enough now because Freddie Mac is looking for a certain amount of skin in the game. And I've seen this just recently, this week on a Freddie conventional deal on a refinance, right? So not even a new transaction on a refinance. This was a $20 million deal in Dallas County, B-class deal, where they said, okay, tell me, 2 years ago, this was a transaction. 2 years ago, how much do the GPs have in the deal? How much skin in the game? And if it was lower than 10% of the equity, they were taking us, they took us from 125 to 130 DSCR because they were light in terms of their skin in the game. So that's something new. We haven't dealt with that in the past.
So they were cutting their loan dollars back.
Cutting their loan dollars, yeah.
Okay.
Even on a refinance.
Any comments on
So
that?
I can agree with all of that information that you just shared, Ricardo, on a deal that I just closed in Cincinnati, a 22-unit building. We had all of those issues. We had two sponsors. They didn't like the seller. They didn't like some of the trailing
Freddie did not
12.
like
Freddie
Freddie
did
didn't
not
like
like
this.
it. No,
Okay.
they didn't. And
because Freddie had the loan.
no, it was a new loan for them, but they just did not like the seller on this thing. And we tried to keep asking questions of the seller. Seller was like, yeah, we combined all of our assets and we just said, 30% of the R&M is going to this asset. So we had to try and figure it all out from a line item standpoint, each of those expenses. But we started out at having to bring in 5% from the general partners. In the end, they required 10% from the GPs. And we got a nice loan from Freddie on that at 74.8%. So we were happy about that. It also came in that they changed the debt service. So from 125 to 130. So that definitely was another thing that they were asking for.
And that was the leverage, Julie. That wasn't the interest rate, right?
No, correct. 74.8 leverage. Yeah.
I think 2024, I'm still calling the year of the refi because that's what's driving all the deals right now. Is if you had a bridge loan in 21 or you did a floater in 20, you have to figure out a way to refi. And the 10-year treasury didn't help anybody really this month. It's come back a little bit, but it's still above 4. And so people are still waiting, right? People are still waiting for the Fed to make their move on a cut. And people are waiting for treasuries to come down because you're still 5.5% to 6%. And it's hard to buy any deal right now when it's an A deal's at 5, a B deal's at 6, and a C deal's at 7 plus to get positive leverage. I mean, I just got off the phone with an investor and, there's no positive leverage. So a lot of people are just on the sidelines for a little bit.
Talk to me a little bit about some of the other things that Fannie and Freddie are doing that folks may be or should be aware of. Some of this mezz debt. Ricardo, you just had a transaction. Talk a little bit about the senior loan is with Fannie or Freddie or so, and then you have a little bit of who's the guy that has the salt bay that does this. The salt comes down on the steak. Mezz is a little bit like that. That gets a little bit higher leverage, makes it a little bit more salty on your steak. Tell me a little bit about what's going on and what you're seeing on that.
Yeah, so there are some options out there where you can add mezz debt on top of Fannie Mae. We've been doing, Freddie Mac allows the pref equity, which we've been doing that for a while, but there are a couple of lenders that will do the mezz on top of Fannie Mae. It's not, they'll take it down to a 110 DSCR. So it usually, adds another 10% to the deal, right? So it's not it won't close a big gap, but so on like a $20 million loan, maybe we get an extra couple $1,000,000 to close a gap if there's a gap needed. Now it's expensive, right? So it goes on top of Fannie Mae. That additional couple $1,000,000 is going to come at around 14%. So it's 8 current, and then the rest on the back end. So it's expensive.
Yeah, 6 accrued, 8 current, 6 accrued, and so
Yes.
it'll be paid off within. It's coterminous to the
Coterminous with Fannie Mae.
yeah.
Um,
So people have been using that on like a lot of refinances because they're trying to pay off their current bridge loan, and they're thinking, well, maybe I'll extend out on the bridge loan if we could, or maybe it's just better for me to take a refinance to Fannie Mae, and maybe put some additional mezz on the loan.
Yeah.
Again, it's like two different transactions that we combine them together. One is the senior loan, one's the mezz piece to the deal. They close at the same time, so it tries to help ownership groups to bring a little bit less to the table. And then I would, force, if you could, what I'm suggesting is try to pay off that mess as quickly as possible, because it's, twice as expensive as the senior loan is. And you want to try to pay it off as quickly as possible.
Yeah, so we spend a lot of time with our clients that are needing to refinance, right? So we did plenty of bridge loans over the last few years, and we've been diligently working on those game plans, to get them out. And the options, if there's a gap, right, in a lot of deals right now, there is a gap, and we either talk about obviously bringing equity, doing a capital call for equity, doing a call for debt from your investors, and then layering on something like either pref equity or mezz to close the gap. So those are the common options, but we spend a ton of time trying to figure out what works for your specific deal and your investors, right? So there are several options. So it's something that takes time, and reach out, and we can definitely help.
Julia, any comments on that at all?
Yeah, no, I would just also talk about, if we're doing an assumption, to consider, is there an option for a supplemental, where you go back for a second bite of the apple. Now, historically, we have seen the maturity of 5 years left on that senior loan, that you can go back for a second bite of that apple. However, it's going to be a little bit more expensive. So if your senior debt is on the assumption is, let's say 3.75, and you've created enough value, or there's enough that you could maybe go for a second, that second could bring in 1 or 2 million, and then you don't have to bring in a bunch more money, but that second is going to be 1% above where we see today's rates.
Yeah.
So you want to make sure that we're cost averaging those.
Yeah, weighted average. I mean, that's a very good point that Julie's bringing up, is that on the acquisition these days, is that if there's a loan that's assumable, people are assuming the senior debt, and then also trying to put a supplemental, like a second lien against the property. James, talk a little bit if what's some of the requirements for a supplemental on maybe a 10 or 12-year term loan?
Yeah, I mean, the main thing is really just the debt service coverage. Instead of a new loan being 125, you're going to be at a 130 cover, and that's on a blended basis, right? So you take your first loan, look at your debt service, let's say it's 4% interest rate, and it's amortizing already, and then you're going to put the supplemental on, coterminous with the first loan, and this is probably going to be in the 7-8% range, just depending on the size of the loan amount. I think that's effective. I mean, it definitely lowers the amount of equity that you have to bring to the table, and it is cheaper money than trying to raise equity right now. So when it was easy to raise equity, nobody cared about any of this stuff. But now, when every dollar is difficult, everybody's trying to squeeze everything out of the lender right now.
Why do most apartment buyers, sponsors, why do they use mortgage brokers these days, and what are some of the benefits that, in your mind, why borrowers are using brokers to source the debt?
Yeah, I mean, a lot of times when you're first starting out in the business, you don't know what you don't know, and you're walking in, and you might walk into a bank and talk to them about their product, and they really have one product, and so the mortgage broker really has access to all the products and understands the terms behind all these deals, and have relationships with these lenders throughout the nation, really. And so depending if you're buying a $5 million deal or a $25 million deal, there's going to be different lenders in different parts of the country who are going to offer the best product. And so, I think a lot of people, when they're first starting out, definitely could use our help in that regard. But then over time, once they sort of get to know us, we become more of a partner in the deal with them and help them not only with the debt, but help them tour properties, help them find properties, help them figure out their refinance strategy. And a lot of these deals, we're not just here with you for 60 days. We're here with you sort of through the life of the loan. And so we're helping you. Like right now, we're probably doing more calls between the borrower and the lender than buyers and sellers.
I'm going to talk about that in a second, because that's 100% true. We'll come back to that in a second. Ricardo, you have to pay extra points and fees, like if you do a Fannie Mae or Freddie Mac loan, or do we just kind of split it with the lender?
The nice thing is the value that we add, with on a Fannie or Freddie loan, we're generally splitting the fees. That 1 point origination that you're going to be paying, our relationship with the lenders that we work with, we do a ton of volume with, so we'll split that fee with them, right? So you're paying 1% no matter what. You work with us, a half goes to the lender and a half goes to Old Capital. And again, because of the volume we generate for our lending partners, everybody's happy. We're able to provide a ton of value to our clients for, pretty much the same cost they would be paying anyway. So it's kind of a win-win all the way around.
Yeah. Two brains for the price of one, as I would usually say. And then we kind of tell some of the brokers too, is that, a lot in commercial real estate, a buyer does not have representation. The listing agent represents the seller in the deal. So think of the listing agent, charging 1 or 2% of a listing fee to the seller, but a lot of the buyer brokers want to take half that fee and do it. And so we kind of look at it the same way, is that someone's going to pay a fee. We're just going to split it. So just like a buyer broker and a listing agent, sometimes they split it, sometimes they don't. But in our world, we split the fee. So again, you're getting two brains for one price, if that makes sense. Julie, anything more to say about that?
No, I think that's all I think one of the struggles that the new people think is they can do this on their own, right? They can call up a bunch of banks, but if you're new to this lending environment, you don't know the right things to ask. And so we do this every day. This is how we make our money, is, dealing with lenders. We know what to share with them and what not to, and what would be a concern for them. So, by doing it on your own, I think you're putting yourself possibly at risk. So that's why another reason why you should use a broker like Old Capital can help you. And this is what we do.
Got it. James, any final words on that?
No, I think we covered it.
Okay. So let's talk a little bit about what James and I were talking about. We were talking about how many calls that we've been doing. A lot of investors use bridge loans to buy apartments in 2021, 2022. And maybe Ricardo, can you give me an idea why there was so many bridge loans instead of Fannie Mae loans in 2021 and 22?
Well, to get a deal, right? To make deals work. That is what made deals work at the time, right? I mean, right now, a lot of people wish they had not done them, but in order to make a deal pencil over that time frame, 9 out of 10 times it required a bridge loan. So that it was the vehicle of choice during that time frame.
If you wanted a Fannie Mae loan, it typically required you to put down 40%.
Right.
Because we had a 125 debt coverage that we had to satisfy. The bridge loans had kind of a debt yield, which means that they were a lot more flexible because you were going to put money into the property to fix it up to increase the NOI for the future. And so they lent the money based on the increased NOI, 2-3 years from the period of time that was originated. So they were able to get 20% down or 80% leverage. So that was a big delta between, say, Fannie Mae and Freddie Mac and the bridge lenders. If you wanted to be competitive, you wanted to buy a deal and you wanted to capture the flag, so to speak, you needed it to do a bridge loan. And that's, and your investors required that too. But a lot of those bridge loans, they weren't fixed rates. They were adjustable rates based on SOFR plus an index plus the profit to the deal. So right now, SOFR is at 533 plus, let's say 3.5 on the deal. So you're paying maybe 8.5% right now. And then we put in some insurance, rate cap insurance on that to try to lower your payments lower to try to help you and kind of fix that rate. So what's happening right now, those loans were for 3 years with 2 1-year extensions. So we're coming to the end of the third year, and people are having to either extend out or, like what Ricardo was saying, refinance out or sell out. And so the modification so a lot of the borrowers are coming to us to try to have us help them in the discussions with their lender. So some transactions we didn't even originate, but we're stepping in to try to help them, and we're not talking about trying to cut the interest rate back, or we're not trying to cut the current loan dollars in the deal. We're just trying to say modify the terms of the loan. And what that really is that maybe trying to bring it back to interest only for that the fourth year, or if they didn't have enough NOI to get a waiver, to get the interest rate waiver in there for the debt yield. And so that's what we're on there trying to help folks. If they can't refinance or they can't sell, we're helping them to try to modify the loan so they can get an extension of at least a year and kind of kick the can down the road. Ricardo, any more comments on that?
No, it's just, I think that is where we're spending the bulk of our time, right? We're underwriting every deal, but these refinances are extremely complex to try to make work. We know all the tricks in the book. We know all the right players. So this is kind of where we add the value.
Yeah, 100%. Talk a little bit about what's going on with the banks, because a lot of people, we talked about Fannie Mae, we talked a little bit about Freddie Mac, but on some of these smaller transactions, you're going to need to have a bank underwrite these deals. And a bank, I'm talking about, I'm not talking about Wells Fargo or Bank of America. I'm talking about a small regional bank or a credit union. What's the first thing they ask for, Ricardo or Julie or James? What's the first thing they ask for when you're starting to talk to them about trying to do a loan for a client of yours?
How much money do they have? Deposits. They love deposits. They love deposits. So we're doing plenty of bank business, right? So it's for a specific type of deal. So usually the first option is Freddie SBL. For some reason, either the deal doesn't underwrite well, for some reason Freddie doesn't want to do it, or if they just want, or if they just want a really easy, flexible exit, right? It's a heavy value add deal. We'll bring it over to one of our banks. We can get good leverage. Your rate's going to be higher, right? You're going to go from 5.5% to 6% to 7.5% to 8%, but it'll be a fixed rate with an easy exit, easy to no prepay penalty. So there's some deals where that works. And then Freddie won't go below $1 million, right? So I'm working on a deal right now that we do some smaller stuff, but it barely qualifies for Freddie. So much so that we're going to go down that route. But a plan B is if for some reason the NOI drops, then we'll switch it over to a bank loan.
What are you seeing, Julie, on the bank side?
Well, I think that one of the challenges that I'm seeing, especially with the banks, is a lot of the investors are not located where the property is. So it's been very challenging to find a local lender who will support that, right? They want somebody boots on the ground, and not all of these groups have thought about that. And that's a challenge. You have to either get somebody new onto the deal, or you have to, see if we can get agency on those deals.
And the other challenging one is with the banks is recourse, right? So,
sure,
you get into a bank discussion, and in this environment, nobody wants to sign recourse, and I don't blame them. Yeah,
a lot of the banks, before they say we would even take a look at this deal, they want to know how much deposits that you are going to be able to bring over to them. So they don't want a transaction, they want a relationship. They want to know that you have maybe 10 to 15% of loan amount in liquidity, and that you can bring that money over to the bank. So Bank XYZ, they want to set up not only your operating account, but they also want to know how much of your personal accounts, whether it's a checking account, savings account, whatever, that you guys are going to be able to bring those over. And really the reason being is that banks are like any business. There's a cost of their money that they have to to charge somebody whether that's they're charging their borrower, but they have to find out where they can get that money at the lowest price. And the lowest price right now is deposits. So whatever they're paying their depositors, they kind of turn around and charge their loan customers on that. And whatever the difference is, the spread is their profitability and their risk of loan loss reserves. So they want to bring it in the cheapest cost of money. So when you go to a bank, be prepared and know that you are going to have to bring in a lot of deposits, maybe 10, 15%. So if, on $1 million, that could be, a sizable number. And just like Ricardo was saying, is that, and Julie was like, the banks want to make sure that you guys are local to the subject property and local to them. A lot of things that they figured out a long time ago is that if there's a foreclosure and somebody has a deficiency balance, which means that they owe more than that they were able to sell the property for, if you're out of state, let's say it happens in Texas, the property's in Texas, but you live in Florida, it's damn near impossible for them to go across state lines to try to collect on that judgment. And so they're like, we're not doing that. So they want everybody to be local. Local means maybe 100 plus miles, maybe 125 or less of closer to the subject property and closer to their bank or their branch. So they can actually want to make sure that you're going out there, taking a look at what's going on with the property. So that's very important when you're talking about banks these days. The first thing they're going to ask for is deposits. And then now just to kind of finish up, what else are you seeing out there that we didn't mention, Julie or James or Ricardo?
Well, I think that one of the things that people are all excited about doing is putting in LOIs, and they're not vetting the deal with the lenders. And what I have seen on several occasions is these new folks are putting in offers and getting these LOIs accepted, and they haven't come by the lender. They haven't just figured out how much capital that your biggest partner, which is your lender, is going to bring. And so they are thinking, oh, we're going to get 70% or 75% because that's what they've been told they can get. But yet it comes in at 55 or 60% leverage. And now you have to go back to the seller and say, hey, oh, by the way, I'm going to need to retract that offer. And I think that puts them at great risk with the broker, with the seller, obviously. And it's a disadvantage at that point. So we've had to kind of walk through some of those deals where they have to retract those prices, and it's just, you lose all negotiation skills or leverage.
Talk to your lender up front. Ricardo, any final words at all? We'll bring it over to James.
No, I think a common theme right now is make sure you've got your team buttoned up. Deals are not easy. If you're new to the business, you definitely need to make sure you have your team in place. And then, on the refinance side, James mentioned this earlier, that's where the deals are happening. So make sure you've got your capital market team in place. Reach out if you don't, and we can definitely help.
James, what are some of the things to get people as smart as possible to listen to you? Is there anything going on in April that Old Capital is doing?
Too much is going on. So we took March off for spring break, and then in April we've got our DFW bus tour, which is 2-day, April 17th and 18th. The first day is in the classroom, really, doing Q&A, going through slides with us and then brokers and property managers. And then the second day is on the bus looking at properties. And then that night, April 17th. So we're giving you 2 reasons to come in town. We're going to have a speaker series with the economist from RealPage, Carl Whitaker, April 17th. And then the next week, if you want to come back to Dallas, or already in Dallas, we are having our pickleball charity tournament. And I think we've got probably 60-70% of the teams already filled out. So if you want to get in on that pickleball tournament, definitely go on to Old Capital Podcast and you can register there for April 25th. It's a Thursday night over in Grapevine. And then are we going to tell them about the conference yet, or are we
Not yet? That's coming down the pike. Yeah, let's keep that hidden a little bit.
Conference is coming, but we'll announce the date here shortly via email. So if you aren't on our email list, go to oldcapitallending.com and there's a subscribe button and you can get on our email list. And every week we'll give you updates on deals closings and what's happening in the old capital world.
Excellent. All right. So Julie, thanks for coming on. Certainly do appreciate that. Ricardo, thanks for spending some time with us. You know, you're a fountain of wisdom, very steady Eddie. He's a guy that doesn't have any of these highs or lows. He is a master of getting transactions done. And the professor, thanks for cutting up a little time before you take off for spring break. So thanks everybody from Old Capital. We appreciate that. Have a good day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.